so in love with you.
Welcome back to Real Estate Mindset. Today's video is going to be absolutely bonkers, you guys. Now, as we wait and watch the housing market continue to unfold as far as the cooling down potentially leading into a crash, it should continue to give those of us who have waited on the sidelines more and more reassurance that our patience and our self-control and discipline will be rewarded. So today what we're going to do is we're going to jump into an article by MarketWatch titled "The Pandemic Boom in Home Sales is Over. Mortgage rates soar to highest level since 2009 as the Fed pressures the housing market." Now, obviously, you guys, what I have been saying over and over and over is that affordability is the number one factor that is going to go into transitioning our market from sellers to buyers market. And we're starting to see that more and more as we move forward into 2022. Now, remember, you guys, these videos are just my vlogs. I'm just sharing with you my opinions. I'm not a financial advisor, although in my career, I am a realtor in Houston and I am a loan officer in Texas. And if you guys could real quick, please like this video, subscribe to my channel if you haven't already. And as always, comment. You guys help me grow. And I think that you help a lot of other people grow too. Some comments anyways, most of our comments anyways, this channel has some of the most awesome subscribers. So mad love to you guys. Thank you for following along this journey with me. Let's get started on this article right now. Okay, the article starts. Mortgage rates are skyrocketing thanks to the Fed, but buyers who can tough out this difficult changing market will be rewarded. And thank you, MarketWatch, for saying this. I'm really happy that MarketWatch is saying this, you guys. Hopefully it gives you guys that are on the fence a little bit more assurance that what you're doing is the right thing. Let's continue. The 30-year fixed rate mortgage averaged 5.27% for the week ending May 5th, according to data released by Freddie Mac. And I shared that with you guys yesterday. That's up 17 basis points from the previous week. 1 basis point is equal to 1/100th of a percent or 1% of 1%, right? So yeah, they're saying 1 basis point is 1% of 1%, essentially. So 100 basis points is 1%. You guys, does that make sense to you? Let's continue reading this. This represents the highest point for the benchmark 30-year mortgage product since August 2009. To put that in context, the last time mortgage rates were this high, Barack Obama was just months into his first term as president. The nation was in the depths of the Great Recession and Instagram had yet to be launched. So remember this, guys, we actually really want higher mortgage interest rates. Do not forget that, right? I actually like the surging interest rates because we need to change this market. We need our housing market to be normal again. Right now, it is way too toxic. Again, this is just my opinion, but it is way too toxic. So thank God we have these higher interest rates. Traditionally, higher interest rates is actually a bad thing, except in the rare situation that we are in right now. We need this cooling off to begin. Now, it's really interesting to put in perspective how long ago interest rates were this high, because even though our interest rates are historically low, the last time they were this high was over a decade ago in 2009. So that's really interesting to consider, you guys. So even though they're still low, they're really a lot higher than they have been in a long time. And also the problem is the massive surge. Essentially 3 months, 4 months is all it took from us to have some of the lowest interest rates to the highest interest rates in about 12 to 13 years, which is really crazy. So the Fed is really powerful. Let's continue reading this article right now. I think this is really interesting, this next part that we're going to read, because it's going to give you guys more factors that are involved in increasing mortgage interest rates. A lot of people think that the federal funds rate being increased is essentially what's driving the mortgage interest rates to surge like this, but that's actually wrong. There's actually many factors, but let's read this right now. Mortgage rates are roughly benchmarks to the yield of the 10-year treasury note. And you guys, I highlighted that in yesterday's video. But the difference between the average rate on the 30-year mortgage and the 10-year treasury has widened recently. Since the end of the Great Recession, which is basically, I think the end was maybe 2011, 2012. Since the end of the Great Recession, the spread between the two has averaged 1.7% points. But currently it hovers above 2%. If the spread were closer to historical levels, the 30-year fixed rate mortgage would still be below 5%. So keep your eye on the 10-year treasury. The Federal Reserve is largely to blame for the fact that mortgage rates increased at a faster pace than might otherwise be expected. According to the analysis by Deputy Chief Economist at title insurer First American, investors who buy mortgage backed securities have already factored in expectations that the Federal Reserve will continue to raise rates throughout this year into their view on the mortgage market. Lenders consequently must hike the rates they offer consumers so that they continue to sell their loans to investors. Those sales are what generates the funds used to produce more mortgages. So, you guys, obviously, there's a direct correlation between the 10-year treasury and the gap between the 10-year treasury and the 30-year fixed rate mortgages. So, it's really important to keep your eye on the 10-year treasury. But also, another factor on mortgage interest rates is the selling of mortgage backed securities. That's why we can have essentially a 200 basis point surge in our mortgage interest rates, but only have a 25 basis point increase in the federal funds rate, which is now overall a 75 basis point increase because of the Wednesday meeting. Jerome Powell obviously came out and said they hiked it another 50 basis points. But there are many, many factors that go into why the sudden surge of mortgage interest rates. And here's the really wild thing, you guys. The Federal Reserve has only just begun. Right? So they have only just begun, and really essentially look at how much power they actually have to continue to rug pull us. What I really don't like about what the Federal Reserve is doing right now is they're not giving us enough clear instructions on what they're going to be doing, right? They once said that inflation was transitory. They once said that they're not going to increase rates until 2023. There is so much that the Federal Reserve is doing right now that they essentially did not prepare us for, right? But that's okay, right? Because again, we want mortgage interest rates to go up. The problem is again, a lot of people were blindsided from that surge. And that is kind of a problem, because really we don't want to hurt first-time home buyers. We don't want to hurt people that are on the market to buy houses, but we do need the market to cool down. And personally, I would rather someone not get a house that's drastically overvalued than desperately get that house. So for the people that were priced out of the market, I'm sorry, but look at it this way. You may have actually dodged a bullet. It is very possible that you dodged a bullet. So think of that. If you're ever depressed about, oh, I missed out on an opportunity, the dust has still not settled. And now we're getting further indicators that the housing market, the boom, it's over, right? Let's continue reading this article right now. This is a little bit of a long read, you guys, but this has some really good stuff in here, and that's why I want to read this whole thing, okay? So just bear with me. Now, while some additional Fed tightening is already backed into today's average mortgage rates, ongoing inflation pressure remains likely to push mortgage rates even higher in the months to come. Hiking short-term interest rates isn't the only way the Fed influences the mortgage market. The central bank itself has been a buyer of mortgage-backed securities since the start of the pandemic. So now that the Fed will be shrinking its balance sheet on bonds, including these securities, there could be an impact on liquidity in the mortgage market. Lenders would need to make up the difference by rising rates. And I don't think, this is a presumption. I think that the Federal Reserve has said they're going to do this. And again, that's why I wouldn't be surprised if by the end of this year, we see rates in the 7%. The shocker is we already seeing rates mid 6%. And it's not even over with the second quarter yet of 2022. So this is really wild. This is really, really wild. Now let's continue. Although recent housing market data has shown the massive effect the surge in rates has had on home buyers, the pandemic boom in home sales is over and activity is back at pre-pandemic levels. That is a bold claim and I love it. Now let's continue. It's clear that the affordability challenges posed by rising rates and higher prices has cooled demand among home buyers. Nevertheless, home listings remain few and far between. That means that home prices will likely continue to grow, albeit at a slower pace. Since even with a reduced pool of buyers, there aren't enough properties to grow around, analysts say. Again, you guys, I don't necessarily agree with this, although I do agree that we need more inventory, but we'll cover that at the end of this video. Now let's continue. Let's finish this article out. And there's the potential that rising interest rates could also put a damper on the supply of homes for sale. Existing homeowners are rate locked in with their existing mortgage rate is below the prevailing market mortgage rate because there is a financial disincentive to sell their homes and buy a new home at a higher mortgage rate. Although I kind of agree with high to low rates, I don't agree with there's not a financial incentive because if they cash in hundreds of thousands of dollars, isn't that a financial incentive? I'm tempted to actually sell my rental because my house has actually gone up so much. The thing is, I'm going to keep my rental because I anticipate rental prices will continue to go up a little bit throughout the year. So I kind of view my current property as a safety net, quite frankly, because I don't know what's going to happen. I don't know what political pressures are going to come into play in the housing market, but I do know if things continue the trend that they're in right now, we're obviously going to have a housing market cool down, but I'm saying that that cool down is going to happen so fast and that our housing market is so artificially inflated by COVID that it will lead to a crash in some areas more than others. So it's really important to map out where you want to live and where you want to buy. Now, I'm going to conclude this video, you guys, with a couple of opinions that I have formulated by reviewing this data. Affordability is what I want to end on. So I have been saying that the affordability is the number one factor at transitioning from sellers into a buyer's market. And what we're seeing right now, guys, is essentially that take place. Obviously, if demand is crippled, right? So if there's essentially no one can afford homes anymore, obviously, you guys, that will automatically bring up inventory, right? Not to mention we have all these new home builders building like crazy. So we're going to start seeing more and more inventory as we move forward into 2022. And I'm anticipating that August, we're going to have double the inventory that we had in March, essentially being over 750,000 listings. That's what I'm anticipating in August. I don't know if that's going to happen, but I can see that happening and I anticipate that happen. So again, like I've been saying for the last couple of months, I believe that the more that we wait throughout 2022, the more inventory options that we will have, and the more likely it will be for us as buyers to get a good deal with buyer incentives on a house, right? So essentially, guys, that's the point I'm trying to make here. I'm going to conclude this video. As always, thank you for traveling along this journey with me. If you're out there investing in real estate, I wish you luck and I hope you win.